There's been a lot of talk lately about yield curves. How do yield curves impact markets?
Probably one of the most fundamentally misunderstood and yapped about topics that we see, especially in a time like this. And it's misconstrued in a variety of ways. And so cutting through all the chaff, what really matters with the yield curve is that the yield curve is a signal. It's not a thing in itself. What you're trying to determine is what are the economic conditions for loans to be making credit, or banks to be making credit and loan activity, bottom line. And so what a yield curve is effectively is short-term interest rate where a bank borrows from the saver or the depositor at a very short-term interest rate, and then they lend that same money out, corporations, auto loans, corporate loans, whatever it is. The difference between those two is the profit for the bank, what they borrow at, what they lend at. So when a yield curve is steep, it means a bank's potential profits are high because if they make those loans, they can profit a lot. It's called the net interest margin. As the yield curve gets less steep and starts to flatten, it means the bank's potential for profit starts to lessen because the spread on what they can make is less. And so the narrowing of the yield curve is a signal, and it tells you maybe you don't want to be as optimistic about banks and financials as you were before. Typically, it's toward the middle of the cycle that financials tend to do better, and towards the end of the cycle, they tend to do worse. And it's a key reason why overall we're underweight financials, both in the US and Europe, although we do hold quite a few of those European banks. But in terms of the yield curve as a signal for a bear market, this is where things get very strange. A lot of people will take things like the 2-year minus the 5-year, or the 5-year minus the 2-year, and the 10-year minus the 5-year, or whatever it is, and all these other metrics. The most durable that we've ever seen is really just taking the 3-month short-term rate and the 10-year Treasury bond and comparing those. And today, it's flatter than it was, but it's still positive. And even tiny positive is still fine for the stock market and fine for the cycle. When yield curves truly invert, when long-term interest rates go below the short-term interest rate, it has to do so for a meaningful amount of time, and it has to be widespread because another widely misconstrued feature is that people just tend to look at their own country and say that yield curve is flat or negative and therefore we're going to have a recession. But the truth is it's a global world, and one of the things that we look at is a globally weighted GDP weighted yield curve, which is still very nicely positive. Because even if there's weakness in one area, it's going to be tended to be picked up by other areas that still have nicely positive yield curves. And one of the things we mentioned earlier was that in fact Europe has a nicely steep yield curve, at least relative to other places. But very importantly, in terms of the bear market and the signal, one of the things that we see the most often is that people get too frightened as the phenomenon of yield curve flattening is happening, when in fact, as it's flattening is some of the best times of a bull market very frequently. And it's not until you either get a true inversion that lasts a while and is widespread that you can really get something that's truly a recession indicator. But if you don't wait for that, you're going to get out way too early and miss out on a lot of the gains of a bull market.
And two amplification points here. One of the reasons that the global is more important than single countries is because in today's world, global banks can borrow in one country and lend in another. They can take advantage of those intercountry spreads. The second point, and Michael said this correctly, but you can amplify on the point that looking at something like the 2 or the 3 year versus the 5 or 10 year is inappropriate because the core principle you're trying to look at is the underlying function of the banks taking in short-term deposits as a basis for making longer-term loans. And banks don't take in much in the 2 or 3 year time range as deposits. What they take in as deposits tend to be very short-term. You could use, as Michael says, the 90-day rate, or you could actually use the overnight rate, and either one are going to show you pretty much the same thing. But because it's the short-term stuff, that's where banks do the borrowing. They take in the deposits, against which they then make the long-term loans. But there has been this tendency in 2018 as people were looking for bad and looking for problems and fomenting and worrying to look for the part that looks the worst, which was the 2 or the 3 against the 5 or the 10. And in fact, if they could, they'd look at the 2.3789 versus the 8.235 if that showed them the worst thing. It's really you want short versus long, and because that's really the signal. And all that really matters is the propensity of the banks to want to lend. Because in the end, What this is really about is, can business and consumers that are adequately qualified to borrow otherwise for basic fundamental purposes get access to credit? Can they actually borrow? And when you take basic economics in school, one of the most principal basic functions that you're supposed to learn that just kind of goes to a lot of people is that in a fractional reserve banking system like we have throughout the Western world, the quantity of money grows by the banking system increasing its net outstanding loans. And that process of banks' propensity to lend is basic and fundamental, and that's what the yield curve is giving you an indication of. But the indication itself is not the be-all and end-all, it's that lending that's the be-all and end-all, which is actually going along reasonably well.
And for views on current events in the world of investing, visit marketminder.com. Updated daily, it offers on-demand access to Fisher Investment's most current thoughts on capital markets and the global economy, as well as our sometimes irreverent commentary. We hope you will enjoy it.